Hello, welcome back guys. In this video we're gonna be taking a look at a not very well known company. It's called Infosys Limited. We can as usual use our company profile page to get some more information about this one. As you'll see, this is an infotech company that's providing consulting, technology outsourcing, and next generation digital services in North America, Europe, India, and internationally. You'll see that this is an Indian company that doesn't really move much, and it's a pretty large one. It has about 300,000 employees over here, absolutely huge. But let's take a look at the company itself. Now, generally speaking, you have seen a lot of the tech companies going down tremendously recently, and this one has been going down quite substantially in the past few trading sessions. Again, I suppose with the rest of the market pretty much. But overall, it's down about 35% since its 1 year high, which is not that much when you compare it to some other tech companies that have been going down like 70, 80, or even 90% in some situations. If you go back to 5 years, to the 5 years chart, you will see that the company was at some point like $7 or so over here, and then it started climbing and then had a little bit of a recent sort of like slump over here. Understandable, of course, the overall market is basically crashing these days, and so you're gonna be taking an opportunity here potentially if you invest in this one. But the question is it really a good investment? And this is what we're going to be examining as usual in this video. Now, this is a $72 billion company. Again, this is not a small company. And let's examine what they are doing here. Now, the PE ratio is 25 and the price to free cash flow is 24 almost. Now, they converge, and this is very nice to see. They're very close to each other over here. This is generally speaking a good thing because it means that net income kind of converts to free cash flow at a similar pace, at a similar pretty much rate over here, which is nice to see. Now, the outstanding shares of the company are going down because the company has been buying back quite some shares. Now, recently they actually sold some. They issued some extra shares over here, I suppose because of the stock price. And you will see that the company has very little total liabilities here, so little debt compared to the free cash flow that they generated last year. You'll see it's about 2 years of last year's free cash flow to pay back all the total liabilities. Revenue, net income, and free cash flow have been increasing rather nicely, as you'll see, pretty much at a similar pace. And it's only the 5 year total equity growth that it's at a similar level to where it was back in 2018. There's a reason for that, and it has to do with the fact that the company has been spending its cash reserves to buy back shares, of course, as you can understand. And very low debt to equity ratio is rather nice to see as well. And net income margins that are looking fairly nice over here, even though they used to be nicer, they used to be better. They're getting a little bit worse through the past few years, but still they are sitting at a very, very nice rate over here. And I'm assuming that once the market goes back to its normalcy, probably in a year or so, maybe a couple of years, who knows, maybe they will have some increasing margins as well because their overall margins are pretty nice here. Again, it's a software company, an IT company here, and they have very nice return on equity here, 31% with a return on capital employed of 35%. Now, 31% without any debt is very, very interesting because again, return on equity can be very, very high if you have a lot of debt. But a company that doesn't have much debt and has that high of a return on equity, that's pretty nice to see. In terms of the dividend yield, a 2% one in the last 12 months, with a free cash flow payout ratio of about 50%, same with the net income payout ratio. Very similar here. 2% is about the dividend yield. And if you take a look at our dividends tab over here, you will see that in more detail, and you will see that the effective dividend yield, that's the dividend yield that's paid today, based on today's price, is 4%. Because the stock has been going down in the last 12 months, we are getting a higher dividend yield if you buy it today. Now, it's interesting to notice that this dividend that the company is paying is not regular. They are not paying it in regular intervals. It's also not regular in terms of how much they're paying. As you'll see, it's up and down quite significantly and quite a lot depending on the quarter here or depending on when they pay. Because you will see that, for instance, in 2020 they paid 2 times, 2019 3 times, then 2 times here, 3 times here. So it's irregular. It's very, very irregular here what kind of the kind of dividend that they are paying for Infosys Limited. And there is a good thing about this one is the fact that no dividend investor is going to be investing in this one for dividends because again this is very irregular and it's not safe. And so if the company actually decides to at some point actually drop their dividend, it will probably not affect the current investors. So I don't expect them to be selling out of the company because of that. Because again, you are not buying this one for the dividend. It's just a little bit of an extra here. So this is good. And me, as basically not a huge proponent of dividends, I kind of like what I'm seeing here. And if the company is actually basically decides to decline, to reduce the dividend, I don't think it will really affect it because it has been happening throughout the years, many, many times here, as you'll see. Okay, so other interesting things here, the institutional holders I found to be rather interesting here for a couple of reasons. You will see here a very, very interesting thing. Morgan Stanley used to have about 7 million of this company, and right now they added 12 more. And they have a current total of about 19.4 million, increasing their pretty much holdings at a 182% over here. That's a very, very substantial increase, almost 3 times as much stock as what they used to have. Now, it's interesting to notice, though, that BlackRock, for instance, actually sold some here. And again, you can examine the finer details here and see which institution bought and which institution sold here. And you will see that in more detail here using our tool. Of course, remember, you can gain access to our tool by becoming a Patreon. A link is in the description box below this video if you're interested. And you can do what I'm doing here for all sorts of stocks. Now, a very nice aggregate data here in our tool that shows you what's been happening as an overall picture for the company, and you will see that there has been some selling recently, with the total ownership of the company going down from what it used to be in the previous pretty much quarters over here, as you'll see. Very, very interesting. Now, in terms of the senators, very interesting to see that there was one senator actually that who has made a few trades here, but right now they're sold out of the company, and there are no insider trades over here. Now, I'm going to examine the financial statements next because this is important to see what the company is doing in numbers. 10 or 11, I should say, billion to 16.3 here. Pretty nice growth over here. And magnified by the fact that the company made a 20% growth, had a 20% revenue growth in the most recent year, fiscal year that is. And if you take a look at the net income from 2.5 to almost 3 billion over here, growing not a ton, but still growing rather nicely. And this is what you want to be seeing from companies. Their last year was very nice over here. Now, the balance sheet of the company, you will see that they're having about 10 billion in total equity, same to what they had in 2018. Again, remember, the company has been buying back a ton of shares here. You can see that. And this is to be expected, the fact that their total assets are about the same, and the total equity, actually, I should say. And the total liabilities have been increasing with 5.5 right now in terms of their total liabilities in billion. And again, if you take a look at the cash flow statement, you will see that they made 3 billion over here, which is what we examined earlier, about 1.8 years of free cash flow to pay back all the total liabilities. Now, if you take a look at their operating cash flow here, you will see that 3 billion converted to 3.4 almost here, 3.34. And if you take a look at their cash from investing activities, minus 1 billion over here is what they did. For the most part, they have been a seller of investments. They have been actually buying some as well, but they have been a net seller in the past couple of years, as you'll see here. And in terms of the dividends, 1.7 over here, and what we love to see, common stock repurchased about 1.5 billion, with a total of 3.3 billion spent for financing activities. Very nice here, and 2.3 in cash at the end of this period. Now, the last step, and very, very important, of course, is our stock evaluation tool. How much is the company worth? How much we should be paying for its stock? And we have our handy little table here with the averages. The company has been making about 10% as an average revenue growth, but you will see that this is affected by the 20% that they did last year. Overall, it's like 7-8%, something of that sort. So I'm going to go 7, 8, and 9 over here. And let's see what we get out of this one. Now, the net income margins on average 19%, a little bit more, but then going down is what we examined a little bit earlier, even at a point where we're currently sitting in the last few months at about 17%. So I'm going to go 17, 19, 18, and 19 here. And in terms of the free cash flow margin, I will go 80, 90, and 100, which is rather typical. It's what we are doing actually. 80, 113 here, 103, rather typical and rather nice to see. Of course, for our expected annual return, we're gonna go with 13%. Very, very typical is what I usually like to see from my companies, at least a 13% annual gain for my money. And if I hit calculate here, you will see that we're sitting at an about $9 to $14 range for our high estimates, with the current price being at about $17. So it's a little bit more expensive, but remember, this is a company that has rather high margins, little debt. It's growing not a ton, but at an okay pace. And last year it actually grew about 20%, which is very nice. And it does make some sense to be potentially paying a little bit more for it. So I think that at a range of maybe even $12, $12 to $13, I think this one could be an interesting purchase. And I would definitely add this to a watch list potentially, just to see whether it will come down to this price and actually become a very interesting buy. But even at this price, I mean, yeah, it's a little bit more expensive, but it's definitely is worth some attention here. And again, especially if it keeps going down a little bit more, gives us an interest, a better entry point here at some point. It's actually been at its lowest level over here, as you'll see in the last 1 year chart, for example. It's sitting at its lowest level. So if it gives us a nice entry point, which could be, I mean, it's still a little bit more expensive, but it could be kind of close, and some people could potentially even think of getting a little bit at this price even. I think it's potentially interesting to and worthwhile waiting a little bit, but it's not that far from where I would like it to be. Maybe even at 14 it would be interesting. So yeah, interesting company to at least add to a watch list and wait it out, see how how it rolls, what happens in the next upcoming quarters or so. But I definitely wanted to make a video for it. I hope you enjoyed this one. Please leave a like and subscribe if you are new around here, and I'll see you in the next video. Bye bye for now, guys. See you soon.